Hello, everyone. So, as you know, tonight is our last night. As I originally did not realize this. I did mention that we don't have time to do a final exam. So, we're going to have a project. And that project will be based on what we're doing tonight with options. It won't be terribly time consuming, I don't think. And I'll post it up there tonight or tomorrow. I don't think I've already put it up, but if not, I'll double check. So the thing is, with something like that, we have to be very conscious of the time because normally they require the grades to be ready fairly soon after the class ends. So I'm going to assume that they need the grades by next Monday. Okay. And so therefore, you should probably have them into me by Sunday night. So Maria, I just sent you an email if you didn't see it. Okay. So let's aim for Sunday night. So it'll be Excel based, which is good. And you'll get to show me some of your Excel skills. And it'll be based on what we're doing tonight. And then that will be it. Hopefully you've handed in everything else. I'll be looking for them in my inbox. The 3 problem sets, chapters 3, 7, and 8. And the midterms should be ready by now or very soon. Okay. And that plus your final exam will represent your grade. Okay. All right. It's hard to believe. Where did the time go? It's already the end of July. Oh my God. But, and of course, you know that this fall, as far as I know, everybody plans to be back in campus in September. And that's really going to be strange after that long layoff. So anyway, that will really make it doubly bizarre when we start up again in September. All right, well, anyway, here's the notes. So we left off in slide 20, and we started to briefly introduce call options and put options. Let me just quickly remind you what we've done so far. Just a quick reminder, an option like forwards and futures is a derivative security, but this time you're given the right to do something, but not the obligation. Whereas with a forward and a futures contract, those are legally binding contracts. If you agree to buy something, you're required to do so. If you agree to sell something, you're required to do so. Here, you have the right to change your mind. And if exercising the option would make you worse off, certainly you will change your mind. All right. So we know that the options can be characterized by several key features, such as the underlying asset that you're allowed to buy or sell, which could be just about anything you can imagine. This is just a short list of options, types of options you can buy. You can buy options on interest rates, on currencies, on equities, individual equities, that is, equity indexes like the Standard & Poor's 500 or the Dow Jones, precious metals, obviously gold, silver, but also platinum and palladium. And also you can buy an option on a futures contract, which means you have the right to enter into the contract. And once you've done so, then it behaves like any other futures contract. The difference being is that once you exercise that contract, you'll collect your profits, if any. Then we have to know the strike or exercise price, the price at which we can buy or sell the asset. And the maturity date, the last day of the lifetime of this option. And often that will be not very far in the future. In fact, most options do not go out much past 6 months. The call option is the one that gives you the right to buy something. The put is the one that gives you the right to sell something. And in addition, we have this classification, European options, that can only be exercised on the actual expiration date. And the American versions can be exercised anytime right up until that expiration date. So between the two of them, clearly the American style options are more powerful, but of course, they're also more expensive as it turns out. So now, as it usually in the marketplace, most options are one or the other. Occasionally you'll find options that are available in both styles, but the choice depends really on what it is you're trying to hedge. For example, interest rate options tend to be European style because you're trying to hedge the risk of interest rates falling or rising on a certain date, on a date when you might borrow money or lend money. So having American features wouldn't really help you very much with an interest rate option. On the other hand, with equity options, they typically are American style because it's going to help you out if you can buy your your stock when you think the market is very, very hot, let's say, and about to rise. Now, finally, and this is what really separates the options from the other styles of derivatives, the premium. That's the price you have to pay to buy that option. They're not free. And that's because we have what's called limited loss potential combined with unlimited profit potential. And that's why we have to pay for these. Now, I think we may have already looked at some examples of this. We can go out into the internet. Let's start with finance.yahoo. And we can go look at a stock. I think it may have been Apple that we looked at. So here you'll see under the options category, these are the options that are available to us in the market. This date here is the expiration date, and you can see there's many of them to choose from. The ones on top are the calls. So let me just randomly pick one. The call that gives you the right to buy Apple stock for $100 is currently selling for $49. Now that's a lot of money, especially because although the examples we've been doing were based on the assumption that we're allowed to buy one share of stock, in reality, with options on stocks, they're typically written on 100 shares. So this option isn't going to cost me $49. It's going to cost me $4,900, which gives me the right to buy 100 shares of Apple at $100 each. Okay, so that is what we mean by the premium. And of course, as you see, as the strike price goes up for a call, the premium goes down. So I can choose which one of these to buy. That depends on what I'm trying to accomplish. Whether I'm gambling or speculating, that will help influence my decision as to which of these options I should buy. And the cutoff point here, this blue line, cuts off the difference between the options that are currently that would currently give me a positive payoff if they were exercised. 146.77 is the current market price. So 147, if I own this call option and it matured today, I would not exercise it because the stock is only worth 146.77, and this option gives me the right to buy it for 147. So these options in white, in the terminology used in Wall Street, are said to be out of the money, which means that if you were to exercise that option, you would actually wind up with a negative payoff. The ones in blue, which are considered to be in the money, and in fact, it even says it right here, mean that in these cases, if I exercise, I'll have a positive payoff. So that's why the line is that blue is there to separate the two, in the money and out of the money. Now, the good thing about out of the money options is that they're very cheap, and which means that the potential rate of return is very, very high. These are expensive, the ones up here, very, very expensive. But down here, sometimes if you're a gambler, you can make a lot of money, like this one, 155. That only cost me 53 cents. Is it impossible for the Apple stock to go above 155 tomorrow? No, of course not. If it does, I could really clean up because they only paid 53 cents. In fact, some of these down here, look at this one. With a strike of 185, this only cost 3 cents. Man, I'm not sure. For 3 cents, maybe I'll take a risk. Okay. Now, of course, the puts down here are the ones that let you sell for that strike price on this date or by this date. And here, the blue ones are in the bottom. These are the ones with the high strike prices, because if you have the right to sell a stock for 147, when it only sells for 146.77, that means you are going to earn a positive payoff. So all of these are in the money. These are out of the money. And if you want to look at some of the later ones, like August 20th, what you'll notice is that pretty much the numbers are similar, except the further out we go, the higher the prices will be. Just right across the board, all of these options will be more valuable if there's a longer time until the maturity date. Okay, because there's more time for the stock price to go up or down and make us even more money. Okay, so that would be the big change. If you compared any of these two dates next to each other, you would see the prices are higher when the maturity date or expiration date is further in the future. Okay. I guess what would I compare it with? I guess it's like, imagine if you paid an entry fee for a contest of some kind. And let's see, what kind of contest might we join? Let's say it's a math contest. We want to, well, there's a prize for whoever knows the most about math. The longer we have until the deadline, I mean, the date of the actual contest, the better off we'll be because we'll have more time to study. So you might be willing to pay more money for a contest that takes place further in the future because of that ability to spend more time studying and increasing the likelihood of your winning money. All right, so let's get back to this. So I believe we did this example with the gold, so we don't have to go through this again. Just remember the payoff to the call option is max S minus X and 0, which means if the spot price, as it's called, of the underlying asset is above the strike price, we'll make a positive payoff. Otherwise, it's 0. And in order to calculate the profit or loss, all we have to do is take the payoff and subtract off the price that we paid for the call. That's how much money we actually end up with. And this could be negative, but since the payoff can't be negative, the worst outcome is negative C, which means we just lose the money we paid for the call. It's like with a lottery ticket. What's the maximum you can lose from a lottery? The price of the ticket. That's it. Okay. As far as I know, I've never heard of a lottery where you could lose more than you started out with. But yeah, so if you think of an option as a lottery ticket, well, that's what the potential loss is, the ticket itself. All right, now, oh, here we go. In the money, remember, if the stock price is above the strike, we said the option is in the money because it would provide us with a positive payoff if we exercised it today. If these are exactly equal to each other, we say that the option is at the money. And if S is below X, the option is out of the money. So these are terms used on Wall Street. Where do they come from? Who knows? We don't. Somebody needs to sit down and write a book about this. Where do all these Wall Street terms come from? Who knows? Maybe it's out there somewhere where it's sold 8 copies. And so we don't see it even on Amazon anymore. But it probably exists. In fact, I noticed this the other day. They're so eager for content that now it's gotten to the point where if you have written a manuscript in Word, say, please, Amazon, could you publish this for me in Kindle form? Not Kindle form. I'm not sure what form it is, but they'll just say, don't worry, we'll do it. And I don't think it even costs any money. I don't know how that works, but you can get anything you've written published on Amazon as long as it's in Word. I didn't really read it that carefully, but that's the sense that I got. But anyway, so here, now, I think this is as far as we got. So suppose now that we have a European call in IBM stock that expires on September 1st, and the strike is $50 and the premium is $3. Now, September 1st is down the road a bit. So what I've done is I've created a bunch of potential stock prices for September 1st. The strike price is locked in at 50. And so you can see we've used that formula to calculate the payoffs, all of which are zeros as long as the stock price is at or below the strike. After that, every time S goes up by $5, so does the payoff. Okay, it goes up to 60, the payoff is 10. And finally here at 75, the payoff is 25. How high can this go? Well, guess what? There's no limit to how high it can go. Why can't it go up to 150? The answer is it can. So as far as the payoffs are concerned, there's always a zero or positive payoff. If you want to be super cool with your mathematical terminology, you would say that the payoff is non-negative. Non-negative, which means positive or zero. Now, if we draw a graph of this relationship, you can see a couple of interesting things. As we just saw, the payoff is zero up until we reach the strike. That's the strike price right there. And then when we get past that point, the payoff is positive. And if you notice, the slope is equal to 1, meaning that if we move $5 in this direction, the payoff goes up by $5. So all of this is the region with positive payoffs. Oh, I've already got it. Okay. There you go. Now that's basic shape is very important because it helps us visualize what exactly is happening with the payoffs to this call, and it applies to every possible stock price. Now, this graph does not show the profits and losses though, but that's easy to fix. Okay, we know that the option will be exercised as long as the payoff is positive, but that doesn't guarantee we'll have a profit. Okay, to have a profit, that means that the payoff must exceed the cost of the option. Okay, so if you have a $3 payoff, but you paid $4 for the option, it means you're still behind by $1. Now, how would we adjust our graph to show the profits? Well, it's easy because we're only subtracting a constant from all of these payoffs. Okay, whatever C is, it's a constant. So what will end up happening, you can see here, I've added 2 more columns. The call price is 3, and that is being subtracted from the payoff. We work our way down, and you can see you've got a payoff that can, profit that can never fall below $3, negative $3, I should say. After that, as we go up with the stock price, the profit goes up too on a 1-for-1 basis. So let's see what that, oh, it looks the same, doesn't it? Except for one detail. The whole thing has been shifted down by $3. So we'll call that minus C. And this whole region down here represents the area of maximum losses. $3. Now, this time we have a new concept to look at. $53 is the break-even point. Which is equal to X plus C. But after that, we have positive profit. But it's $3 less than the payoff. So the shape is exactly the same. It's just shifted down to reflect the cost of the call option. So now the reason why these diagrams are so important is because, first of all, it helps us understand what's going on. But secondly, we can consolidate these into interesting trading strategies that will let us speculate or hedge in ways that are not possible with other types of securities. Not even futures and forwards. Only options give us the right to do what we're going to see later on. And it's possible to place very precise bets on what's likely to happen in the market. So with IBM, if you know what you're doing, you can actually set up a position where you'll only make a profit if the stock price stays between, let's say, $50 and $55, but everywhere else you lose money. Something like that. You can certainly do it. So anyway, now it's ready time to look at the puts. Now the puts are the ones that give you the right to sell. And one more thing. Let me sneak this in here. Calls are used to, number one, hedge the risk that the underlying asset, the price of the underlying asset, will rise, or speculate that the price of the underlying asset will rise. So in the first case, you're trying to prevent that from happening, or prevent losses. And in the second case, you're hoping that it will happen because that's what you expect to say. Okay, expect to happen. So that's when calls are useful. If you need to hedge the risk of a rising price or speculate that that will happen, that's the way to go. Now, with the puts, everything works in reverse because you have the right to sell the asset and you benefit when the price drops. So let's say you're feeling very pessimistic about a stock that you own, but you don't want to sell it just yet. You can make money if it goes down by owning a put option. In fact, often financial institutions will have these portfolios and they don't want to be constantly buying and selling stocks or other assets because it's costly. And they may think that in the long run, the stock will do very well. So they also want to avoid short-term losses. So rather than sell the stock, they'll buy a put option. And if the price does go down, well, that hurts, but at least they'll get some profits from the put option to help offset that. So the puts are designed to help us when we think that the price might go down, or we're worried that the price might go down. And so it stands to reason that the payoff to the put is the reverse. Let me just put this back up here so you can remember. The call payoff is the max or greater of S minus X and 0. You can see we've reversed the X and the S. So when S falls, X minus S rises because your X is a constant and you're subtracting a larger number from it. Therefore, it goes up. Okay. Now, what about the profits and losses? Now, this is a payoff. How do we calculate the profit or loss to a put? Well, just like with the call, you take the payoff and you subtract the premium. Okay, so I'll remind you once again, too, the call, profit or loss, is max S minus X and 0 minus C. So this makes perfect sense. You got the payoff to the put and you subtract off the premium. All right, now, of course, you probably can anticipate what's coming next. We need a graph or two graphs. And so we can visualize this relationship. And also try to figure out when in the world would you ever buy a put. The moneyness part, this part is actually a little different. Because the payoff is max, X minus S and 0, in the money means you have a positive payoff. So now the stock price has to be less than X for it to be in the money. X equals S is at the money for both cases. And when S is above X, now the option is out of the money. The opposite of what you get with a call. All right, so this time we've got a put on IBM stock. This time, let's make it American just for the fun of it. It doesn't affect the results anyway. Expires on September 1st. The strike is 50. The premium is $2, which brings up an interesting point. For a call and a put, let me mention that in here. Just as a note, for a call and a put with the same underlying asset, time to maturity, and strike price, in general, the call tends to be more expensive than the put. Not always, but that's often the case. There's a lot of very technical reasons for that. But in our example, remember the call was selling for $3, so the put is only selling for $2. So it's not that unusual for this kind of thing to happen. You might think, well, they're both, have the same features. No, typically the call is a little bit more expensive. All right, so here's the diagram. Now, first, here's the table. Same setup, same scenarios. Now look at these payoffs. They start out very high, and they work their way down to zero pretty quickly. Because here, we want the stock price to be less than the strike price. And that's true up until here, and then after that, it's all zeros. So what do you suppose this graph is going to look like? Ooh. Well, I'll show it to you. Oh, here we go. Look at that. So here we have our strike at 50. Payoff is 0. And now from here on in, now here's one way. Oh, by the way, let me just go back and grab the graph from the call. Just a quick reminder. If you see them side by side, you'll notice something interesting. Basically, it's as if I flipped the call from left to right to make the payoff diagram for the put. Okay, so in other words, if you look at them side by side, they're essentially mirror images of each other. Now, the one way in which they're different, though, is that unlike with the call, where the payoff is a maximum payoff, there is no maximum. With a put, there's one thing that prevents the payoff from being unlimited. What is it? What do you think? Why doesn't this go up forever like it does over here? Because the stock price can't be negative. So if S equals 0, the payoff will be X. That's as high as it can go. So unlike the call, where there's theoretically no upper limit to our payoffs, here there actually is one. Although it's a very high limit, it can't go past that. So that's one way in which the two are not perfectly symmetrical with each other. But it's a very high maximum. Believe me, 50, are you kidding? You probably paid $2 for this option. Now you're getting a $50 payoff. That's a pretty sweet rate of return. Something like, oh my God. That's 2,400%. That's a pretty nice. Have you ever made 2,400% on an investment? I don't think I have. Wow, that's a killing. All right. So now, of course, we also have to figure out what to do about profits and losses. Just like before, we're simply subtracting the put price to get the actual profits and losses. And so the whole thing shifts down by $2. Here's the maximum loss region. And it happens to equal $2 because that's the put price. That's it. That's as bad as it gets. And then the break-even point occurs when we've earned enough of a payoff to cover the cost of the put. After that, profits are positive. Nice. So if you're very pessimistic about the stock, well, you know what? You can buy a put and make some money. Now, it's like, imagine if, let's say where you work, it's a publicly traded corporation, and you know that your company is grossly mismanaged. And, you've tried to explain this to people, they don't listen to you. You say, this company's heading out down, 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 down. What you could do, I don't think this would break the law, is buy puts on your own company. Because even though you work there, I don't think that's considered to be inside information, but I'm not a lawyer, so maybe don't listen to me. But let's just say for some reason you become pessimistic about any stock. It doesn't matter which one it is. Well, go ahead and buy a put. The worst thing that can happen is you lose the put price, but if you're right and it goes down 10%, 20%, you could really do very well. All right. That's the put. Now, here's something that we haven't thought about, though. We've been ignoring this aspect of this. When you buy an option, somebody has to sell it to you. It's just like a stock. You can't just go out and buy a stock. It has to already exist. If I buy a stock, somebody else out there had to sell it to me. Now with stocks, once that transaction takes place, the seller of the stock is no longer involved. They wipe their hands. They say, thank you for the money. And that's the end of it. That's not true with options. During the lifetime of the option, the buyer and the seller are directly related to each other, because if I buy, let's say I buy this option from JP Morgan Chase, okay, it's an investment bank and a commercial bank. And of course, I'm sure they have option trading in the city somewhere. And I call them up and say, listen, guys, sell me a call option on Apple stock. If I make money with that option, guess whose pocket that comes out of? This seller. Okay. So let me just show you a quick example of this. In order to buy an option, there must be a seller, which is also known as a writer. I don't know. Again, with these names, I don't get it. But and the way this works is that the profits of the buyer match the losses of the seller, and vice versa. Well, so you can see why, because I have the right. So in other words, if I bought the right to buy Apple stock, if an investor buys a call on Apple stock with a strike of 150, and the price rises to 160, the investor has the right to buy the stock for 150 from the seller so the seller's payoff is minus $10. Now I thought we said that there's no negative payoffs. That's from the buyer's perspective. So if I make it now, as far as the profits and losses are concerned, suppose that the call costs $2. The seller's loss is minus 10, but plus 2 because they got to keep that money. Okay, so minus 10, but plus 2, so it's minus 8. They keep the premium from the option, but then they suffer the negative payoff. Therefore, the buyer's profit must be $8. So it comes at the expense of the seller. So being a seller is very risky. In fact, being a seller in a lot of ways is like being an insurance company. Why do I say that? You'll see. In some ways, the position of the option seller is like the position of an insurance company. And when you think about it, policyholders pay a premium to the insurance company. If something goes wrong, the insurance company must provide a payoff to the policyholder. So in other words, you know what the insurance company is doing? They're saying, listen, I'm collecting all these premiums. I'm hoping that I never have to make any payoffs, that the policyholders are very careful drivers or they're very healthy people and I never have to pay them any money. In fact, I don't know if any of you have ever seen the TV series Monty Python's Flying Circus. There actually was a sketch where a vicar comes into the insurance company and says, listen, why didn't you pay off my claim? I mean, clearly I crashed the car and all this and that. And they go through their files and they go through and they find the right information and say, vicar, here's the problem. You bought our never pay policy. According to the terms of this insurance policy, we never have to pay any claim that you make. Well, that's not how it works in the real world. That's Monty Python world, not the real world. So anyway, so we're going to look more formally at the option sellers or writers. We're going to look at their payoff and profit diagrams and see how that's different from the buyers. Now, the reason why this is so important is because you may think, oh, I would never sell an option. But if you're setting up a trading strategy, you might find yourself both buying and selling at the same time. So this applies to everybody, not just in, like brokerage houses or investment banks. You and I can do the same thing. Okay, if you have a good enough position with your broker, let's say you have an account with a full service broker and lots of money. And you call up your broker and say, listen, I want to set up a strategy where I'm buying this option and I'm selling this option. They'll say, no problem. We know who you are. We know you're good for the money if you lose it. But yes, under normal conditions, there might be restrictions on this, but if your position is strong enough, you can do this too. So anyway, let's see how this goes. So everything works backwards between the buyers and the sellers. For example, now here's the thing about being a seller or writer. We have limited potential gains and unlimited potential losses. But isn't that the same thing as an insurance company? What's the best that they can hope for? that nobody ever files a claim, that they'll keep the premiums. But, what if everybody crashes their car? Could the insurance company go out of business? Of course. In fact, there exist companies that are called reinsurance companies. You may have heard of them. What happens is if insurance companies feel that they've got too much exposure to a particular type of risk, they can't very well cancel the policies because they've gotten themselves in over their heads. They can actually sell them directly to the reinsurance company, who basically acts like a broker. Yeah, there's a place called Swiss Re, which is a reinsurance company. They buy policies from insurance companies. Or it's like banks. You may not be aware of it. If you have a mortgage, there's every possibility that your bank sold your mortgage to somebody else and you never knew, because your own bank continues to service it, but the mortgage itself might be in the hands of Fannie Mae. For all you know, you would never know the difference. In fact, if you call them up, I'm not even sure they would tell you. So yeah, absolutely. In fact, it happens all the time. So now, of course, here's the big advantage to the seller. They get to keep the premium. And that's the whole point of all this. So let's look at these payoff profiles. Now, quickly, I'll remind you, whoops, this is for the seller or writer. So you're going to use your powers of observation and tell me how they're different. Well, actually, I guess I don't have room to write the word call again. I'll just write it down. All right, what's different? I'm pointing a laser beam at that spot, more or less. Yes, it's negative. And so with the call, if you notice the payoffs to the call buyer and seller add up to 0. And the same thing is true for the put. They add up to 0, don't they? They have to. In economics, we sometimes call this a zero-sum game, meaning that the gains of one side has to match the losses to the other. It's like when you have a bet. You bet on somebody about the outcome of a football game. If you're right and you win $10, it has to come from the other person's pocket. You can't both win and you can't both lose. Now, when you take into account, though, the premiums, this is where the seller starts to make up a little bit. What they're aiming for is that premium. And again, you'll see that's for the call. And you can see it's just the negative. The signs are different. They add up to 0. Now, here's going to be the fun part. What do you suppose the diagrams will look like? So let's go back to the IBM call option with strike 50 that sells for $3. This is the profit. These are the payoffs to the seller or writer. And all I've done is made this negative. Remember, before it was 0, 0, 0, 0, 5, 10, 15, 20, 25. Now this is what's different. Well, let's see what that does to the diagram. Oh, now let's see. Let's see if I still have this on the clipboard. Yes, I do. So it's like I flipped the payoff to the call upside down. Ah. And so I can imagine the call option, the buyer is looking in the still lake and he sees the reflection, he sees the call seller. Okay. And now, though, when we take into account the profits, or sorry, the premiums, we add $3 to the position of the call seller. The whole thing shifts up. And guess what we have up here? We have a maximum profit of C dollars. Here's the break-even point. And then guess what? Losses everywhere you look. Is there any limit, by the way, to how much the seller can lose? No. Boy, I wouldn't want to be in that position. I can make $3 max, but I could lose unlimited amounts of money. I don't think I could sleep at night if that was my position. All right. Now, what about the puts? All right. Well, the put is going to be the reverse of what we had for the buyer. So let's take a look. Oh, yeah. Let me go get the diagram for the buyer real fast, because that way you can see them side by side. Oh, I had it. Okay, here it is. Well, it's just what you think. I mean, you're just flipping it upside down. Okay, so the seller, you lose money if the price goes down. You break even up here, or at least your payoff is zero. All right, just the opposite of the put buyer. Okay, so let's see. And then when you take into account the cost of the position, remember we collect the premium. Wow. Break even. And then, of course, these are all losses. All right. Now, I did promise you some strategies. So let's take a look where we're combining these positions. Now, there's many different ways of doing this, and what we're about to see is just the tip of the iceberg. So we're going to look at two basic types of strategies. We have spreads and we have combinations. We're going to look at a few of them. But remember, now the possibilities are endless here. What's different about the two is that this one is either two or more calls or two or more puts. This one is at least one call and at least one put. Okay, that's the difference between the two cases. And you'll see when we look at these strategies how they're different from each other. So we'll start with the case of the bull spread. Now, everybody knows that when things are going well in the markets, everybody is bullish. Bullish means optimistic. So the strategy in a nutshell, it doesn't matter. In my example, we'll have calls, but we could just as easily have done this with puts. So you basically buy, in our case, and then you buy it with a low and sell a call with a high strike. Now, by the way, the two calls must have the same maturity or expiration date and the same asset. Otherwise, it is not a bull spread. It is something different. And there is such a thing, but we're not going to look at that here. So whatever the stock is, basically all we're doing is saying, well, let's buy a call with a relatively low strike and sell a call with a relatively high strike. So we're going to go back to IBM now. We already saw this option. The call has a strike of 50 and a price of $3. It matures on September 1st. There's another call with a higher strike of 53 and it only costs $2. We've already seen that the high strikes have low prices. So how much does this position cost us? We're buying $3, but we're also collecting $2. So the net cost of this position is $1. But what happens? Now, it's very difficult to visualize this without a graph. So I put together a little table. Now, remember, the first strike was 50. This is the first option. This is the one that we bought. This is the one that we sold. So we can, and plus, if you notice this negative sign because we sold this one. So I'm going to calculate the payoffs the normal way, and then I'll add them up. And you'll notice something interesting here. The smallest payoff here is 0, and the largest is 3. Everywhere in between, as the stock price goes up, so does the payoff. So you're probably wondering what this graph is going to look like. So let's take a look. Oh my God, that is so cool. I like that. So the payoff is 0 down here. The payoff is 3. And everywhere in between, the payoff is positive, but less than 3. Oops, not 3, 0. So basically what we're doing here is setting up a position that's very cheap and will make money if the stock price rises, but it can't, the payoff can't go above $3. Now, we did mention earlier that the net cost of this position is $1. So in order to graph the profits, we have to go back to our chart and subtract $1. And so now, all of a sudden, the minimum position is a loss of $1. The best we can do is a gain of $2. In between, as the stock price goes up, so does the payoff, or profit rather. So basically, we're shifting this bull spread graph down by $1. And here's the result. So we have a maximum loss here of $1. And the maximum profit, actually, I shouldn't put that there. And then in between, now there is a break-even point equals 51, which is okay, it's $51. And that's their final position. And again, it's called a spread because we have two different calls, and the only way they're different is with their strike prices. So the purpose of the bull spread is to speculate that the price of the stock will rise in the future, but not by a considerable amount. Now, if that's what we believe, we can buy a bull spread instead of a single call. It'll be much cheaper, but then there's a maximum profit that we can earn. All right, now here's a combination. A combination, again, means you've got potentially just one call and one put. You have to have at least one of each. And one of my favorites is called the straddle. You might look at it and say, what a bizarre position. So again, now this time, we're buying two things. We're buying a call and we're buying a put. Everything's the same. The strike, the maturity, the underlying asset. So let's go back to the IBM example. And we've got the two European calls with a strike of 50. Now remember, we said earlier that the call is likely to be more expensive than the put. And so that's what happened here. We bought both of these. So this is a pretty expensive position. It's going to cost us $5. So what happens? Let's find out. All right, I put them together. You can see the payoffs for the call and the put. And there's the payoffs. Now let's look at the graph. Wow, what's going on here? The payoff is positive if the price of the stock goes up and if it goes down. Oh my God. Now that is a nice position to be in. The payoff to this thing can't be negative. Now, of course, what we still have to take into account is the fact that this is a pretty pricey position. So let's introduce the cost of the two options, $5, adjust the profits, or at least compare these with the payoffs. And now look what happens. Okay, so here's the strike. Now here we have X plus C plus P. And here we have X minus C minus P. These are the two break-even points. Either one of them will bring us to zero. After that, we have a positive profit. Okay. Now, here's the challenge. What exactly are we hoping to accomplish with this thing? This is an unusual situation. We're basically betting that the stock will not remain within a narrow range of prices. In other words, we're hoping that the stock price either goes up or down. So in other words, we will make money if stock prices rise a great deal or fall a great deal. In other words, the investor is betting on volatility. Okay, volatility, meaning that the price will bounce around. So either we don't really care which way it goes. If it goes up a substantial amount or down, we still make money. In other words, unlike the other positions we've been looking at, all of the other positions you've seen so far benefit from each movement in the stock price, either up or down, but not up. They can be considered to be directional bets. All right, so there is no other set of securities where we can do this. It has to be done with options. All right, now the last thing we want to do here is take a look at actual pricing. In other words, up to this point, we've been assuming that we knew, let's say that this option costs $3 and this one costs $2. Now, where does this come from? So what I'm going to do is very briefly introduce you to a mathematical formula, which you'll not have to memorize. We have some templates here for you to set this up because these are very complicated formulas, but it's important to have some exposure to them as well. All right, so yeah, you don't want to have to deal with this, but you should still be able to use these templates. What's going on here? Well, the model I'm referring to is called the Black-Scholes model. And now, interestingly enough, unlike forwards and futures, which are very simple to price, options are very, very complicated to price. And in fact, options trading in the US was really held up by the inability of traders or anyone else to find out the appropriate prices of the options. So this academic paper comes out in 1973, written by Fisher Black, Myron Scholes, and Robert Merton, in which they developed a model which is called the Black-Scholes model, whose only purpose is to price European call options written on non-dividend paying stocks. Now, eventually, the Nobel Prize was awarded for this model. By that time, Fisher Black had died, so this award was split between Myron Scholes and Robert Merton. So the Nobel Committee felt that this was such an important development that they were given the Nobel Prize. Now, they were right, because a lot of option pricing models, a lot of derivatives models are based on their framework. So they're assuming a lot in this model. The returns of the underlying asset follow the normal distribution, which is this bell-shaped curve here, the black one that is. The volatility of the asset is constant during the lifetime of the option. The risk-free rate, which is a treasury bill yield, is a constant throughout the life of the option. In practice, this normality return isn't really true. The black curve represents what the normal distribution looks like. The red is what it really looks like. So it's off a bit. So yeah, let's jump ahead a little bit here. These assumptions are not necessarily true, but the model works very, very well. Now let me show you what it looks like. And you might say, ouch, that's scary, a scary model. That's, by the way, why it's already in Excel for you. These are the details. We'll see in a few minutes. And there's another part too. ND1 and ND2 come on the next couple of pages. So C is the call price, S is the stock price, X is the strike price, R is the risk-free rate of interest, T is the time until the maturity date of the option in years, This is a function from statistics that lets us calculate normal probabilities. All right, so let's skip through some of the technical details and let's look at an example. Suppose we have a 1-year European call option on XYZ stock with no dividends. The strike is 50, the 1-year risk-free rate is 2%, and the stock sells for $52. The volatility of XYZ stock is 30% on an annual basis. Now, we could go through all the equations here, but in Excel, look what I've done for you. So the stock price is 52, the strike is 50, the risk-free rate is 2%, the volatility is 30% per year, and the time to maturity is a year. So all the intermediate calculations are done for you here, and right here, that's the appropriate price of the call option, about $7.63. It's all done. I'm sparing you all the gruesome details. Now, here's an interesting outcome of this model. Even though it's only meant to price calls, we can actually calculate puts as well, as long as they have the same underlying features, like the same strike price, the same asset, and the same time to maturity. And of course, it's a year. Oh, by the way, I almost forgot to mention, I think I did mention, this only works for European options. For American options, the models are far more complicated, but this was the starting point. Black-Scholes invented this great model for pricing European options. Other researchers advanced their work to price American options. So the put price comes to us from this wonderful relationship called put-call parity. And we can prove this. We're not going to. You plug in the numbers that you have, and there's your put. It's approximately $4.65. Right there. It's approximate. There's a couple of ways of doing this, but this one is coming from put-call parity. So there's the formula. This one is coming from another derivation. You don't have to worry about it. And there's all kinds of technical discussion here. But I just want you to see what this model looks like and be able to use this spreadsheet to come up with option prices. Now, like I said before, originally this was only meant to price call options on stocks that do not provide dividends. Later on, the model was extended to price other types of options. And so, in other words, assets that have some kind of a cash flow that belongs to the owner. Well, here's what they ended up doing. There's only a couple of minor changes here. This little Q here represents the continuously compounded return to the underlying asset. So if S, for example, is the British pound, then Q would be the British pound rate of interest. So the model is a little bit different. So imagine the following situation. Stock sells for 30, and the interest rate is 3%. No, sorry, the dividend yield is 3%. That's the dividend. The risk-free rate is 5%. What would be the Black-Scholes price of a 6-month European call option when the strike is 28? Now, here's an interesting question. And by the way, this is on a separate template. Let me put it up here. This is number 2. Whoops, this is number 2. Now you'll know right away because there's a Q here. There wasn't a Q in this one. It's just blank. The Q is meant to represent the yield to a stock or the return to an option, a currency, whatever the case may be. So when you plug in these numbers, now the only thing you have to watch out for is a 6-month option means half a year. So T becomes 0.5. All right, be careful with that. Don't turn that into 6. T is measured in years, so 6 months means 0.5. The rest of these are annual numbers. Okay, so you plug them in, and there it is. The price is just a hair under $3. And the corresponding put comes from the modified version of put call parity that takes into account the return to the underlying asset, and that proves out to be about 72 cents, which all you have to do is type in the right numbers and you're all set. All right. Now, oh, that's it. So now what can we do now? Well, the project, let's see, is this the project? Let me see. There's no point in being mysterious about it. Okay. So here's what you would be asked to do. Wherever you see blanks, these might be the solutions, but these are the payoffs. Remember we did these in the charts in the slides? What you would be asked to do is fill in whatever's missing, in this case, the payoffs and the profits for the four basic positions: the call buyer, the call seller, the put buyer, and the put seller. And then you might be asked to do one or two simple strategies, but you'd have to be told what they are. In other words, this is the bull spread, which means you're buying. Let's see, how is this working? I see. I was way over too far to the left. So you've got, remember we had a strike of 50 and another strike of 53. What you would be asked to do, and I'd have to obviously make sure that the answers aren't there, is fill in the payoffs, the profits and losses, and at the end, the combined position. Okay, so that now I don't know if you all know how to do graphs in Excel. If you do, you can go ahead and graph this. If not, well, the payoffs and the profits would be fine. Okay, so you see what happened here. Hold on one second. Yeah, these are the profits and losses of the bull spread. So there's a couple of others in here that are very, very simple. And then what I probably would also do is give you a template for the Black-Scholes, and you basically just have to provide the information here. And I think that's good enough for a project. Okay, so I'm trying to keep it as short and sweet as I can. And since we're unfortunately out of time this semester, there isn't really a whole lot else we can do. So basically what you would need to do is you can follow along with the slides and basically fill in whatever charts are missing, whatever parts of each chart are missing. So you can end up telling me, for example, what are the profits or losses to a bull spread? And if there's any others, I'll explain to you what they are. For example, we have this thing called a bear spread, which is exactly the opposite of the bull spread. In other words, instead of buying a low strike call and a high strike call, selling a high strike call, you're reversing those. And look what ends up happening. Interesting. So the project won't be that complicated at all, after all that worrying. You're just being asked to basically do some basic options, payoffs, and profits, along with a couple of simple Black-Scholes examples. Are we up for that? Can we do that? Yes, we can, and we can do it very quickly. Because remember, we really need the grades by next Monday, just in case. We don't want to get a bunch of zeros in our transcripts, do we? No. But all right, so I guess we can, normally we'd have our break here, but I think we're done. I don't think there's anything else we need to cover. So I'll get that out there tonight or tomorrow. And then you'll have almost a week to get it done. But basically, it's primarily being done with templates so that you shouldn't have any trouble with it. It's too bad we don't have more time for this. It's really interesting. Some of these, oh, there's our old friend, the straddle. By the way, look what happens when you do not buy the call and the put, but you sell them both. you have what's called a reverse straddle, and it's just a big upside down V. And here you only make money if the price stays in a narrow range, and you lose if it goes outside that range. Here's a weird one. Oh, it's not. Oh, okay, I see. I was going to fill that in later, I guess. So yeah, the sky's the limit when it comes to these option strategies. So I think that would be a fun final project, don't you? Yes, we do think that. Good. All right. So I guess we'll stop right about here. And I guess, well, sadly, I won't see you again until the fall, maybe, or depends on what happens, but maybe next spring or next summer again. And so here, I guess we'll call it a night. I'll make sure everything gets posted tonight or tomorrow, along with the video. And then I guess that's it. So, Maria, we can talk tomorrow about your questions. And because I have to go off to do something else now anyway. Otherwise, yeah. So, but yeah, we can take care of that tomorrow. And everybody else, we all good? Excellent. All right. So, well, it was a fun class, I hope. And I'll see you all again in the future, I hope. Okay. All right. So good night, everyone.
Thank you, Professor.
Okay,
Enjoy the
bye.
rest
Have
of
a
your
good night.
summer.
Okay, you too.
Ooh, Professor.